Welcome to Pinnacle Tutorials. To access our entire curriculum, join Pinnacle Tutorials and gain access to our lecture videos such as this one, study resources, as well as revision content to help you excel in your studies and score good grades. In today's lesson, we're going to look at Unit 1, the business and its language, and Unit 2, recording financial transactions. By the end of this session, you will be able to explain why accounting is called the language of business, list the different forms a business can take, and, this is the important part, walk through step by step how a single transaction moves from a scrap of paper onto someone's desk all the way into a set of financial statements. So get your notebook ready and let's begin. Why do we call accounting a language? Let's start with a question. If I handed you the financial statements of two completely different companies, let's say Mopani Copper Mines in Mufulira or Shoprite Checkers in Kitwe, would you be able to compare them and tell me which one is doing better? If your answer is yes, then the only reason that is possible is because both of them are speaking the same language. The language is accounting. Think about how English lets two strangers from different backgrounds understand each other. Accounting does the same thing for businesses. It takes something as messy and varied as buying, selling, borrowing, and spending, and it translates all of that activity into a standard set of numbers and reports that anyone in trained accounting can read anywhere in the world. There are three things that make this language work. The first is standardization. We don't just record transactions however we feel like. We follow specific rules and standards. You hear these referred to as the IFRS, the International Financial Reporting Standards, or the GAAP, the Generally Accepted Accounting Principles. These rules exist so that a bank in Lusaka or an investor in London and even a tax officer at ZRA are all reading the same story when they look at a company's books. The second is communication. The reports we produce, the balance sheet, the income statement, the cash flow, these are how a business speaks to the outside world. An investor doesn't need to sit in your shop for a year to know whether you're making money. They read your income statement and it tells them. And the third is decision making. Numbers on their own are just numbers. But once you translate business activity into structured financial information, a bank manager can decide whether to give you a loan, and you, as the owner, can decide whether to open a second branch or hold back for a year. Now, what exactly is business? Let's ground this. A business, in the simplest terms, is an organization that produces, buys, or sells goods and services in order to meet the needs of customers, while at the same time generating value for whoever owns it. Notice the two-sided nature of this definition. Number one, a business exists to serve a customer. For example, Pinnacle. It exists to serve the clients who access our tutorials. But it also exists to serve or benefit the owner. Hence, it's not free. So, if only one of these things exists in a business, then it's not really functioning as a business. For an entity to qualify to be called a business, it should have both aspects: to serve customers and to benefit the owner. Now, out of that activity comes either a profit or a loss. This one is intuitive, but let's be precise about it because examiners will want precision. Profit occurs when the money coming in from sales exceeds expenses, and expenses is simply the money going out to keep the business running. A loss is simply the opposite, when expenses are higher than the revenue. Let us picture a woman selling tomatoes at Soweto Market. If she buys a crate of tomatoes for 100 kwacha and sells all of them for 160 kwacha, she has made a profit of 60 kwacha. If because the tomatoes went bad before she could sell them all, she only recovers 70 kwacha, then we would say that she has made a loss of 30 kwacha. That is the entire concept of profit and loss. And everything else you learn in this course is really just a more detailed way of tracking the same idea. Now let us look at the different forms a business can take. Businesses don't look all the same. And the form a business takes has a real consequence, especially around who is liable if things go wrong. So let's go through the 5 main forms. The first is a sole proprietorship. A sole proprietorship is owned by one person. This is your typical tuck shop or a salon that is run by a single owner. The defining feature here is that, and this is something that oftentimes we get wrong as students, the defining feature of a sole proprietorship is unlimited liability. What this means is that if the business fails or owes money, the owner is personally responsible for those debts. Your personal property is not protected. If the business owes a supplier 5,000 kwacha, for example, and they are not able to pay, the supplier can legally come after the owner's own personal assets to recover that money. Another form of business is a partnership. A partnership is owned by 2 or more people who share both profits and management responsibilities. Think of 2 friends who pool their savings to an open hardware business, okay? They share the workload, they share the decisions, and depending on how the partnership is structured, they typically share liability too. Then we have a limited liability company or an LLC. This is a different but very important type of business. This type of business, it is different in an important way. The limited liability company has a separate legal identity from its owners, which we also refer to as it having a separate legal entity. So what this means is that the business itself can own property, it can sign contracts, and it can be sold in its own name. And the owner's personal liability is limited to what they invest in that business. This is why many growing businesses eventually convert from a sole proprietorship into a limited company. It protects the owner's personal assets because the business is a separate legal entity, unlike what happens in a sole proprietorship. We can add a cooperative and a franchise. So a cooperative is owned and managed collectively by its members to meet a shared need. Think of farmers' cooperatives. They are a good example where a group of maize farmers pool resources to buy inputs such as fertilizer in bulk or to access a shared market. And then the profits that they make, as well as the decisions that are made, they are shared among the members. Finally, we have a franchise. A franchise is where someone operates a business using the brand, the systems, and the models of an already existing company, usually in exchange for fees and a share of revenue. A good example of a franchise is a fast food outlet like Hungry Lion. They operate under an international brand name, but they are run day to day by a local franchise owner. So, for our members from Zika SCCA, you need to know all these five forms. For our members at CBU, I would advise that you stick to a sole proprietorship, a partnership, and a limited liability company. I should also note that for a limited liability company, it can be public or private. A public limited liability company is the one that lists its shares on the stock markets, such as Lusaka Stock Exchange, while a private limited company is the one that is owned by private individuals, for example, a family or a group of employees who come together to form a company. Now, take a moment and ask yourself, which of these five would expose an owner personally if the business collapsed? If your answer is sole proprietorship and to a large extent partnerships, you're already thinking like an accountant. I will also give you a task to go ahead and research the advantages and disadvantages of this form of business. And in our next discussion, we are going to go through them. Let us now move on. We will now look at the branches of accounting. Now, within accounting itself, there are two major branches. So let's be very clear what they are, and we should not confuse the two. The first is financial accounting, and the other is management accounting. Let us briefly look at what they are and who they serve. Financial accounting is focused on external users, agents such as investors, people interested in putting their money in the company, creditors, people who would get things on, such as suppliers, okay? Tax authorities, for example, the Zambia Revenue Authority, regulators, and so on and so forth. Financial accounting follows strict rules. It is historical, meaning it reports on what has already happened, and it is legally required. If you are preparing statements to submit to Zambia Revenue Authority, for example, or to show a bank for a loan application, that is financial accounting. On the other hand, we have management accounting. Management accounting is for internal users, the managers running the business day to day. It is flexible, meaning there is no external rulebook forcing a specific format. It is also futuristic, functioning as a planning tool rather than a historical record, and it includes both monetary and non-monetary information. For example, a manager might track not just quarter figures but also staff turnovers or customer wait times. Now, here's a simple way to remember the difference between financial accounting and management accounting. Financial accounting looks backwards and reports outwards. Management accounting looks forward and reports inwards. So why all this fuss? Why must we prepare financial information? What makes accounting information actually useful? It is not enough to just produce numbers. Those numbers need certain qualities to be genuinely useful. There are 7 qualitative characteristics you should know, which are very much examined in your exams. The first one is relevance, the second, reliability, third, completeness, fourth, cost effectiveness, fifth, comparable, sixth, understandable, and seventh, timely. Let us briefly look at all these. Financial information should be relevant in that it should provide all the necessary details that will allow the user to arrive at an informed decision that is not biased. It should be reliable in that whatever is presented there should not be altered in some way so that it has a predetermined outcome. Financial information should be complete. It should show all aspects of the business without having any gaps in it. It should be cost effective, meaning that the cost of producing it should not be lower than the benefits. The benefits of the information being produced should outweigh the costs of producing it. It should be comparable because we should be able to check the difference between previous periods. Another reason why most of the times it is standardized in order to facilitate comparability. It should be understandable. And understandability is very simple and straightforward. So financial information ought to be simple and straightforward so that it should be understood by its users. Should also be timely. Financial information should be timely because it should be able to give management or its users an informed decision within reasonable time. And on the aspect of timeliness, let us take a look at an example. What would happen if a production process is using more materials than what was budgeted for and a loss is incurred? If that is spotted quickly, financial information will be able to quickly rectify it. But if it is spotted at the end, it is not useful to produce that information because it does not serve a purpose. A loss has already been incurred beyond the set times. We can also make this into a practical example. Imagine a bank is deciding whether to lend money to a business. If a financial statement is 6 years out of date, then it's not timely. The bank cannot trust them for a decision happening today. If the statements leave out a major loan the business owes, then they are not complete. The bank would be making a decision based on a false picture. If the figures were prepared using accounting methods so unusual that no other business in the industry uses them, they are not comparable. And the bank cannot benchmark this business against other similar ones. Every one of these characteristics exists to protect the person reading the statements from being misled. So this is why good accounting information should have these 7 qualitative characteristics. Now, for most of you who know me, you should have heard the story of how I was lost in a financial accounting course because the lecturer who was teaching me at that time referred to a pen as a B-roll, and I was stuck the whole time thinking a B-roll was some fancy technology or some fancy terminology in accounting, only to discover it was a pen. It could have easily been a ballpoint. So, in order to desist other people from going through the turmoil that I experienced in the past, let us look at some key terminologies we must know. The first one is an asset. An asset is an economic resource controlled by the business. Assets are split into 2 categories: current assets and non-current assets. Current assets are economic resources which are used up or converted into cash within 12 months. Think of things like inventory, which is just your stock, or cash in the till. And then we have non-current assets. These are kept for longer than 12 months, like a delivery van or a shop building. The other term that you need to know is a liability. A liability is an obligation the business owes, that is, money to pay or service to provide. And just like assets, liabilities are split into current liabilities and non-current liabilities. Current liabilities are due within 12 months and non-current liabilities are due any period longer than 12 months. A loan due in the next month is current. A bank loan for 5 years is mostly non-current. Then we have capital. Capital is the amount the business owes the owner. Yes, owes to the owner. This tends to confuse a lot of us as students because we think that capital is the owner's money in the business, which is true, but from the business's point of view, once the money is put into the business owes it back to the owner. That's why capital sits on the same side as liabilities in the accounting equation, which we will build on properly in Unit 3. Then you also need to know drawings. Drawings are assets the owner takes out of the business for personal use. If our tomato seller who we talked about takes 40 kwacha from her sales to buy groceries for her family, the 40 kwacha is drawings. It reduces what the business owes back to her. And finally, accounts receivables and accounts payables. A receivable is money owed to the business by the customers. You sold things on credit to someone, the customer who hasn't paid yet, that is what we call a receivable. Payables, on the other hand, are monies that are owed to suppliers by the business. In instances when you bought things on credit and haven't paid yet, you are having a payable. So one is money coming in eventually, and the other is money going out eventually. Now, let us pause there. That's the entire foundation of Unit 1. So before we move on to Unit 2, ask yourself, could you explain in your own words the difference between a sole proprietorship and a limited liability company, and the difference between a receivable and a payable? Are you able to identify the differences between financial accounting and management accounting? If yes, then you're ready to move forward. Now that we have understood what a business is and how accounting communicates, let's look at how the raw activity of a business actually gets captured. Every sale, every purchase, every expense, someone has to write it down somewhere in an organized way. And this unit is about that. Why does this matter so much? Well, there are 5 reasons why recording financial transactions is important. The first is that it ensures accurate reporting. So these statements that are prepared reflect the true position of the business. It also supports decision making because it gives managers reliable data to work from. It creates accountability and an audit trail. If, for example, the Zambia Revenue Authority or an auditor ever asks, prove this transaction happens, you need a paper trail to point to. And that's why recording financial transactions is important. It also helps to track performance over time so that you can compare this month's income to last month's. And finally, it ensures legal compliance, particularly around taxation, because tax authorities require verifiable records. Let us now look at the journey of a transaction. Now, I will need you to pay close attention to this particular topic because this one is one of the most testable ideas in introductory accounting. The accounting process happens in 4 stages, and every single transaction, no matter how small, passes through all 4. So let's follow one transaction the whole way so that it doesn't become a distraction. Let us imagine you run a small hardware shop and today you sell cement to a builder on credit, meaning he will pay next week. Stage 1 is the source document. This is the first piece of written evidence that the activity happened. In our case, that's the sales invoice you write out to the builder, which will list what he bought and how much he owes you. The second stage, which is stage 2, is the books of prime entry. And these books can also be called the books of first entry or the day books. And sometimes we call them the diaries of the business. Because transactions are recorded here chronologically, we look at them as diaries. And then you will find that in the day books, transactions are input in the order in which they occur before they go anywhere else. So since this was a credit sale, it would be recorded in what we call the sales day book. From there, we have stage 3, the ledgers. From the day book, the transaction gets posted in 2 specific accounts. In this case, we would post in the builder's individual account in the sales ledger. So you know exactly how much he personally owes you, and also into the general ledger, which keeps track of the sales accounts overall. Then stage 4, we have the financial statements. So in this part, this is the final destination of our transactions, where all of this is recorded, organized into data from potentially thousands of transactions, which gets summarized into reports that tell the full story of the business. So you need to know that the process is, it begins with the source document, then goes into the prime entry books, then the ledger, and finally the financial statements. If you remember nothing else from this unit, remember that sequence, because almost every exam question about accounting cycle is really just testing whether you understand that flow. Now, let's go into a little bit of detail with this, because source documents come in several forms and you need to be able to identify which is which. The first one we're going to look at is an invoice. An invoice is probably the one you encounter most. So, a sales invoice is issued when you sell goods on credit. If your record shows that a buyer bought something on credit, you can be able to make demand on it. So this is why in our records, we always issue a sales invoice for every credit purchase from our business, or every credit sale rather from our business. A credit invoice, okay, which is a sales invoice, is a business's record and the buyer's proof of what was bought and what is owed to the business. Then another one invoice that you need to be aware of is a purchaser's invoice. A purchaser's invoice is the same document as a sales invoice, but just from the other side. If it is you now who is buying goods on credit, the supplier's invoice to you becomes a purchase invoice, which is a record and proof that you bought goods on credit and you owe the particular supplier. Then we have credit notes and debit notes. These sometimes confuse a lot of us as students constantly, so please let us pay close attention to get the differentiation between the two. A credit note, which is essentially called a negative invoice, is issued to a customer to reduce what they owe you. It's most commonly used because they returned the goods. So remember the builder that we talked about earlier, for example? If that builder returned 2 bags of cement because they were damaged, you would issue him a credit note to reduce his debt by that amount. On the other hand, a debit note works from your side as the buyer. So let's say You send a debit note to a supplier asking them to reduce what you owe them because you're returning goods to them. Or in our example, if the builder sends a debit note to us to request us to reduce what he owes us by the amount of the damaged goods that he's retaining. So that is a debit note. Then we have the most popular one, a receipt. A receipt is simply proof that a customer has actually paid you. It is evidence of money received in cash transactions. And finally, we have check counterfoils or vouchers. So these are simply a business's own evidence of monies that it has paid out. From here onwards, let's now look at the books of prime entry, which are also known as the day books or the diaries of the business. Firstly, we have what we call the sales daybook. The sales daybook records all credit sales. And then we have the purchases daybook, which records all credit purchases. Notice that I'm using the word credit here. This is because cash sales and cash purchases do not go in these particular books. These two books, the sales daybook and the purchases daybook, only focus on credit sales and credit purchases respectively. Then we have the cash book. The cash book records all transactions involving money, which is at hand or at the bank. So any transactions involving cash at hand or bank is recorded in the cash book. These may be things such as payments and receipts that involve actual moving money rather than just a promise to pay later. Okay? You get something, you come to Pinnacle, you enroll into the course and immediately pay for it. We record it in the cash book. Of course, Pinnacle doesn't do credit sales for the most part, so we don't really have those. You only gain access when you pay. But for other people who may have businesses where they do credit sales, when people promise to pay, those go in the credit sales. Okay, let's go to the returns day books. So the returns day books, they come in two types. We have the returns inwards, which is also called the sales returns day book, and the returns outwards, which is called the purchases returns day book. So the return inwards journal records goods that customers send back to you. For example, the builder sending back the two damaged bags of cement. They will be recorded in the returns inwards. The returns outwards journal records goods you send back to suppliers. So on their end, they would record those two bags of cement in the returns outwards. A simple way to remember this is this. Inwards means it's coming back to you. Outwards means it's going back out from you. Okay? Then we have the petty cash book. This one handles small everyday expenses. Things like buying airtime for the office phone or paying a boy to deliver a parcel across town. These are too minor to process through a full system every time, so small cash float is kept specifically for them. And we record all those little menial transactions in the petty cash book. No wonder it's called petty, because they're small. Then we have the general journal. The general journal is the catch-all for all unusual and infrequent transactions that don't fit neatly into any of the other day books we've discussed. For example, if we are correcting an error that was discovered later, it can't fall in any of the other books, so you'd record it here. Or perhaps you have bought an uncurrent asset like a motor vehicle. You would record it in the journal. Because let's say, for example, you are running a hardware. Motor vehicles are not inventory, so that's an unusual purchase. So you would record it in the general journal. I should also note that the type of business determines what is not a daily activity transaction and what is. Okay? So do not generalize things. Now, once a transaction has been captured in the debtbox, it gets posted into the ledgers where it's organized by account rather than by debt. So the sales ledgers, for example, hold an individual account for every credit customer. So you can see customer by customer exactly who owes you what. Okay? If Banda came in and took in some roofing sheets, Banda has an account showing how much he owes. If Mulenga came in and took bags of cement, their account is in the sales ledger showing what he owes you. Similarly, we have the purchases ledger, which works the same way, but this one is for suppliers. If you went to build Connect to get cement from them on credit, you would have an account for them there. If you were with Palfrey and took some items on credit for them to use in your hardware, you would still have an account with them so that you see what you owe them as a business. Okay, so purchases ledger, it has individual accounts for every credit supplier in order to show you what you owe each one. Your sales ledger, it has an individual account for every credit customer to show you exactly what they owe you. Then we have the general ledger, which holds everything else. So with this one, all your asset accounts, liability accounts, income accounts, and expenses accounts, they are in the general ledger. This is really the heart of the entire accounting system, and it's where the next units on double entry will take us in a much more deeper lesson. So when all this information is collected, finally it is organized and summarized into financial statements, specifically the statement of comprehensive income, which shows whether the business made a profit or a loss over a period of time, and then the statement of financial position, which is just a snapshot or a screenshot on a specific date of everything the business owes, and is worth to the owner. Okay, so this is it. Now let's do a final recap by walking through our content example one more time quickly from start to finish. So you sell cement on credit, you write a sales invoice. That's the source document. You record it in the sales day book. That's the book of prime entry. You post it to the builder's account in the sales ledger and into the sales account in the general ledger. That's stage 3 of the process. And then at the end of the month, the sale becomes part of the revenue figure that appears in your statement of comprehensive income, which is stage 4. Okay? One transaction has 4 stages, and by the end of this course, you'll be able to do this in your sleep. So that brings us to the end of today's lesson. We've covered why accounting is called the language of business, the different forms a business can take, the 2 branches of accounting, what makes accounting information useful, and the full journey a transaction takes from source documents to financial statements. In our next lesson, we're going to build directly on this by looking at Unit 3, double entry bookkeeping, and Unit 4, the trial balance, where you'll finally see exactly how debits and credits work and why they always have to balance. Make sure you're comfortable with today's material before then, because everything from here builds on it. Remember, to access the rest of this curriculum, including revision content and past question papers, join Pinnacle Tutorials. See you in the next lesson.